Good morning, everyone. It is Thursday, November 21st. That went fast. Hope everyone's deer hunting went well. I skipped last week to be busy with work and then deer hunting, so hopefully everyone had a great week and deer hunting went well. Thankfully, my wife and I were both fortunate enough to harvest an 8 pointer each. Unfortunately, I decided to cut myself while skinning the deer. So, it was a good opportunity to teach my daughter why not to cut towards yourself, even though I obviously wasn't trying to. So, with that, welcome back to another retirement planning coffee talk. I don't believe I saw any questions ahead of time. If I did, I apologize, but I will do my best to make this conversation as valuable as possible. Please leave comments, questions, or thoughts in the comments at any time during the video so that I can address them and make this conversation as valuable as possible for you. As a reminder, weekly retirement planning coffee talks are a casual way for me to connect and answer questions, even if you're not a client, at no cost. Join us on Facebook Live or stop by my office to enjoy free coffee. If you'd rather not ask questions online or in person during the live session, feel free to message me directly or simply enjoy your coffee at my office and we can chat once the live video wraps up. There's no pressure to, and just for those who don't know, my office is at 1520 Highway 32 East, Suite E. It's upstairs at the Fricke Plaza. So if you'll see my sign right next to the Easy Pack and Ship. Come on up, take a seat, enjoy your coffee. I think I turned the Keurig on, so feel free to do so. I'm happy to. I have time set aside till about 9:30. I'm happy to chit chat and have as much coffee as you'd like. There's no pressure to work with me or become my client, whether you join in person or online. My mission is to provide my clients with the highest quality advice and service possible. To maintain this level of care, I limit my practice to 100 active clients at most at any time, as I have a fiduciary responsibility to each of them. While I cap the number of clients I work with, I'm dedicated to serving as many people as possible by sharing valuable information and answering your questions. That's why these coffee talks mean so much to me. Disclaimer: this content is not legal, tax, or investment advice. Always consult a qualified professional regarding your own situation. And since this is a live session, I may occasionally make a mistake, but I'll do my best not to. And I am a qualified professional to give investment advice, but we have to sign legal paperwork and things like that for this to be legal advice. So I'm looking forward to some great conversations and hope you have a wonderful day. Please feel free to comment with questions anytime, now or during the video. I'd much rather answer your questions than read through articles that may or may not be relevant to you. With that, I'll give you guys a moment to ask any questions that you have or leave any thoughts that you may have. All right, while you're thinking about questions or thoughts to have, I'm going to just double check to make sure that I didn't miss any pre-questions. I put out a post a couple days ago, seeing if anyone had any questions that they'd like me to address. I don't see any. All right, so with that, I will pull up an article here, and it's written by Fidelity.com, and it's from Fidelity Wealth Management. It says 3 ways an advisor can help make a difference. Working with an advisor can help give you confidence. And I think confidence is a huge thing that we all wish we had more of. For key takeaways: investors who work with an advisor are generally more confident about reaching their goals. Industry studies estimate that professional financial advice can add up to 5.1% to portfolio returns over the long term, depending on the time period and how returns are calculated. That's an amazing amount. Now, I would never guarantee that we'll add that, but adding up to 5.1% is a pretty incredible multiple, right? Over a 1 year period, let's just say you've $500,000. I know you can't see what I'm doing here, but please, if you can, if you're able to follow along numerically, that's great. And if it's a struggle, reach out and I'll go through this with you personally. I haven't quite figured out how to share my screen when doing a Facebook Live yet, so I apologize for not being a technology whiz. But with that, let's just say you have $500,000, and let's just say you're going to get 5% return on your own. At the end of the year, in 1 year, you'd have about $525,000. Now, if an advisor could add up to 5.1%, so you now got 10.1% return over 1 year, instead of having $525,000, you'd have $550,000. So if that advisor is charging you, let's say, like I do, I charge my clients 1% for assets under management. If they're charging you 1% of $500,000, which is $5,000, that might seem like a lot, but if they're able to give you up to $25,000 more return in that year, is that worth it? Would you give me or someone $5,000 if they give you back $25,000? I think the answer is almost always yes. Right now, that's over a 1 year period. What if we look at a 30-year period? Because let's be honest, if you're looking at a retirement, hopefully you live for 30 years, but also your money and your legacy is much longer than 30 years. So 500,000 over 5%. Again, I'm just making up numbers. Nothing's guaranteed. It's just hypotheticals. But I'd be happy to discuss more in depth. But $500,000 growing at 5% over 30 years would grow to about $2.16 million. Now, if we put that to 10.1%, which, like the article says, having a financial advisor can add up to 5.1% to your portfolio returns in the long run, rather than 500,000 turning 2.16 million over 30 years. At 10.1%, it could grow to $8.97 million over 30 years. That's a $7 million increase, right? That's a pretty massive difference. So with that, with those numbers out there, hopefully that's helpful and you can follow along with those ideas. Continuing with the article, good advisors will work with you to create a personalized investment plan and identify opportunities to help grow and protect your assets. And I think the most important thing to understand with that is that a financial advisor's job is like 20, I'm just making, give or take, depending on the person, it's about 20% picking a portfolio and like actually implementing a strategy, and 80% maintaining the strategy and the emotions and the human nature and psychology around maintaining that strategy over a long period of time. Because every day the news is going to try to scare you. Every day life events are going to happen. They're going to make you question if you should change something. And every day your emotions may or may not cloud your judgment about your money, which is where a financial advisor can be huge, right? I mean, there's a reason why every single professional athlete I'm aware of has coaches. The coaches don't do it better than them, but it's someone else to kind of bounce ideas off of and have an outside look at what they're doing. So going back to the article, when we make big decisions in life, most of us look for a source of expertise and guidance to help us make thoughtful choices to meet our individual goals and needs. In fact, investors who get professional financial advice are more likely to feel confidence about achieving their goals. Percentage of investors who say they feel confident about reaching their goal. Saving for retirement without advice, 76%. With advice, 90%. Again, percentage of investors who say they feel confident about reaching their goal for estate planning. Without advice, 74%. With advice, 91%. Saving for vacation, 78% without advice, 92% with advice. Minimizing taxes without advice, 45%. With advice, 68%. Saving for long-term healthcare expenses without advice, 75%. With advice, 87%. The source is 2021 Fidelity Investor Insights study. Furthermore, industry studies estimate that professional financial advice can add up to 5.1% before portfolio returns over the long term, depending on the time period and how returns are calculated. But for most investors who choose to work with an advisor, advice is not just about investments. It's also about helping you pursue your goals, grow your wealth, and take care of the people who matter to you most. Here are 3 ways a good advisor can help make a difference in helping you reach your goals. 1. Works with you to create a personalized investment plan. When you work with an advisor, you generally receive support from a dedicated professional who can help you bring your plan to life. An advisor will ask you about your personal and financial goals and work with you to help answer such questions such as, are your spending and cash flow appropriate? What does financial protection mean to you, and how important is it? What does growth mean to you, and how important is it? Are your investments aligned with your preferences? How will you manage your investment portfolio? Together, you can develop a documented investment plan that articulates your long-term goals, short-term needs, risk tolerance, and personal values. This plan can act as a guide for future decision-making and provides the advisor with information necessary to help you devise and document an appropriate asset allocation and, if applicable, a tax-sensitive investment strategy to help you invest in the asset classes and accounts that best suit your objectives and risk tolerance. Having a documented investment plan can be a big help in staying the course in times of uncertainty or volatility, and can help an advisor provide the guidance and encouragement you may need to stay on track to avoid sometimes costly mistakes investors can make during volatile markets. Number 2, can help you identify opportunities to help protect and grow your assets. An advisor who understands your long-term goals is well positioned to help you identify strategies and techniques that can help you grow and protect your wealth. I'm going to take a brief pause, take a drink of coffee, and give you a chance to ask questions. Seeing none coming in, so this may include tax loss harvesting. Investment losses can help you reduce taxes by offsetting gains or income. Retirement income planning. Preparing for your future needs is essential to ensuring you can maintain your lifestyle through your life plan. Tax smart withdrawals. Reducing the amount you pay in taxes can potentially help extend the life of your retirement savings and open up options for wealth transfer. Roth IRA conversions. Converting some of your IRA savings to a Roth IRA may potentially reduce taxes on withdrawals in retirement. Health savings accounts. An HSA offers triple savings, where you can contribute pre-tax dollars, pay no tax on earnings, and withdraw the money tax-free now or in retirement to pay for qualified medical expenses. Pretty good deal. Advanced college saving strategies. Accelerated gifting and, when possible, opening a 529 within a trust can help optimize savings and may enhance your growth potential. Charitable donation strategies. Gifting assets rather than selling them and donating the after-tax proceeds can help maximize your gift and provide a larger charitable deduction. Number 3, build your relationship with you to better plan for your specific needs. By getting to know you, your family, and your feelings about investing in your future, an advisor can better plan for your specific needs and help you adjust, amend, or extend your plan to keep it relevant as your circumstances change. An advisor can also help you evolve your plan as you prioritize new goals or manage life events, and help you manage risk and consider opportunities as markets or tax laws change. By scheduling regular check-ins, perhaps quarterly or semi-annually, an advisor can help you to review whether your objectives and needs have remained the same or whether circumstances require you to update your plan. This can also be an opportunity for the advisor to connect you to specialists with experience with estate planning, personal trusts, to help develop a plan designed to help you keep more of your money and may be able to help protect your legacy for generations to come. A good advisor is a partner on your financial journey. Financial advice is more than just numbers and investments. It's a process that can help you make a plan, chart your progress, and hopefully achieve your personal and financial goals while feeling more confident along the way. Again, that word confident keeps coming out, right? So I think that does a pretty good outline. Keep in mind, it's up to 5.1%. There's no guarantees that it'll be 5.1%, but I can pretty strongly say that having that outside source of information and someone to bounce ideas off of can definitely add confidence, right? So what questions or thoughts does anyone have on that? I'll give you a moment to think of some and put them in the chat. While you're doing that, I will put the article in the chat as well, in case you'd like to read into it further. All right, so seeing no questions yet, I will move on to another article that is hopefully valuable to you, and hopefully I'll get some questions or thoughts along the way. This article is written by Dimensional.com, and more specifically by Wes Krill, PhD, Senior Investment Director and Vice President. The article is titled, "Election Results Should Not Dictate Your Investments." The U.S. presidential election has concluded, but uncertainty remains what comes next. For those focused on market returns, it can be helpful to look at the historical success of markets across presidencies. It's important for investors to remember that whether you are optimistic or pessimistic about the future state of the world, you should be optimistic about the market. This is easy to demonstrate using a time when optimism was in short supply. By the end of March 2020, the state of the COVID-19 pandemic painted a scary picture of what the future held for the economy and life in general. And yet, divesting from stocks at that point would have been an expensive mistake. From the market's bottom on March 23rd through the end of the year, the MSCI All Country World IMI Index, basically an all-world index, returned nearly 74%. That's a lot, right? So that'd be like $1 turning into $1.74, or $100 turning $174, or $1 million turning to $1,740,000. That's a lot of growth you could have missed out on if you listened to fears and the news. Finishing the year higher in level than before the start of the pandemic. Why did this happen? Market prices continually reset to offer positive expected returns given expectations each day, and consumers continue to consume. We weren't going to malls or theaters, but there was still demand for goods and services, and business owners continued to operate with the goal of profitability. If the world kept spinning on its axis during this period and markets grew investors' account balances, it's worth asking what will be different this time. And that's kind of the end. So there's a bunch of disclaimers and stuff and disclosures and a chart that I'm not going to go into. But again, I will include the link in case you want to look into it yourself. And if you want a copy sent to you, just reach out and I'm happy to send it to you. I hope the point made there is clear enough as to why, one, it's valuable to have a financial advisor, like we talked about, to ignore fear and emotion in the news. But also, two, why we shouldn't allow fear, emotion in the news to affect our long-term strategies based on short-term events, okay? So, any additional questions or thoughts anyone has on that? All right. I'm not seeing any, so I'm going to pull up one more last article here. And it's written by Christine Benz on Morningstar.com, and the title is Yes. Good morning, Brett. Thanks for checking in. Do you have any questions, thoughts, or comments you'd like me to address while you're here? If you do, please just leave them in the comments chat, or you can direct message me and I'll do my best to answer them. The title is Yes, RMDs can improve your portfolio. Required minimum distribution related tax bills hurt, but surgical pruning of problem positions can help you raise cash and reduce risk. So for those who aren't aware, RMDs are required minimum distributions, which apply to your tax deferred assets like in 401ks and IRAs and the such at a certain age, somewhere between 71 and 75, depending on how old you are. They've changed the laws recently, so it does fluctuate on when yours kick in. But it's basically the government coming in and saying, I don't care if you want to spend this money or not, you have to take a certain level of distribution from your tax-deferred assets and pay the taxes on those assets. All right, so the article goes in, many retired Morningstar.com users find themselves with the high-class problem of resenting the required minimum distributions. Their RMDs force them to pull money out of their tax-deferred accounts above and beyond what they need for living expenses and trigger tax bills to boot, which is also a bummer when tax bills are triggered because it affects your Social Security taxes and your Medicare costs. I've also heard retirees complain that RMD tables force them into a more aggressive withdrawal rate than they're comfortable with. Of course, you can always reinvest the money back into other accounts. True. But RMDs, like taxes, are inevitable. Not taking them isn't an option, since penalty for missing an RMD is 25% of what should have taken and didn't. Plus, the taxes are still due. The penalty had been 50%, but was lowered starting in 2023, owing to the retirement legislation known as the Secure 2.0 Act. Even though the penalty can be reduced to 10% or even waived altogether if you correct the error and can prove that the missed RMD was due to a reasonable error, RMD subject investors should not monkey with the RMD deadline if they can help it. Yet taking an RMD does not have to be all negative. With a little lead time, you can use your RMDs to improve your portfolio's risk-reward profile. Rather than giving each of your holdings a haircut to raise the cash for the RMD, or automatically cutting back the most conservative positions, the starting point for approaching RMDs is to check up on your portfolio, armed with knowledge of its problem spots. You can then concentrate your RMD-related sales in those areas that you want to fix anyways. As long as you take the right RMD amount from your own IRAs, it doesn't matter which holding the money comes from. You can then use your RMD proceeds to achieve still other goals. Step 1. Determine your RMD amount. The starting point for strategic RMD taking is to find the amount you're obligated to take out. All traditional IRAs, not Roth, are subject to RMDs. That includes SEP IRAs and simple IRAs, as well as plain vanilla traditional IRAs. Assets in company retirement plans, including Roth 401ks, are also subject to RMDs, as are inherited IRAs. Roth 401k assets were once subject to RMDs, but starting 2024, they no longer are. Was that redundant or did I misread that? Okay, so I'm going to read that again. Assets in company retirement plans, including Roth 401ks, are also subject to RMDs, as are inherited IRAs. Roth 401ks assets were once subject to RMDs, but starting 2024, they no longer are. So she wrote that very awkwardly. They used to be subject. They no longer are. To determine RMDs for 2024, find each account's market value at the end of 2023, Armed with that dollar amount, find the RMD table that corresponds with your situation. Most account holders will use the Uniform Lifetime Table. A separate table applies to account holders with spouses who are more than 10 years younger and who are sole beneficiaries. But don't necessarily stop there. One aspect of RMDs that helps you be strategic is that you do not have to take an RMD from each account. For example, you can add your RMD amounts from all the IRAs in your name, SEP, Simple, and Traditional, and take a single withdrawal from just one of the accounts, which is nice because maybe one account's way more up than the other ones. If you're doing tax loss harvesting, maybe one's way further down than the other ones. RMDs from multiple 403b plans can also be consolidated in this fashion, as can RMDs from inherited IRAs. Yes, it's also important to bear in mind which RMDs can be consolidated. If you have both an inherited IRA and a traditional IRA, different rules apply to withdrawals. If you had both a qualified company retirement plan and an IRA, you must take separate RMDs from each account. If you have multiple qualified plans and are subject to RMDs, you must fulfill your RMD obligations for each account rather than consolidate. It's also worth noting that spouses can't combine the RMDs and take the amount from just one of their IRAs. Even though your finances may be combined, the accounts are in each of your names, not joint, which actually comes up a lot. It's interesting how often people ask if they can share an IRA or mix the requirements between their IRAs. But IRA stands for individual retirement account. So even though you're married, file taxes together and everything like that, they're still separated. Step 2, survey your asset allocation. Armed with your RMD amounts, turn your attention to your portfolio. Start by getting a view of your portfolio's asset allocation. Morningstar's X-ray functionality in our portfolio tool does a good job with this. Then compare that, or work with your financial advisor. Then compare that to your target allocations. If you identify imbalances, you may be able to address them, at least in part. With strategic pruning of appreciated holdings, for many investors, you have been taking a hands-off approach to their portfolios. Their equity holdings are apt to be enlarged relative to their targets because stocks have handily outperformed bonds over the short and long term. And of course, U.S. stocks have dramatically outperformed foreign because your portfolio's baseline asset allocation will be the main determinant of how it behaves. It makes sense to pull your RMDs from those asset classes that you'd like to cut back on. For many investors today, you don't have cash on hand to pull their RMDs from. U.S. equities are a logical place to look when they're up. She's saying as of today, right? This is also a really important point, whether it's RMDs or just growing your wealth or taking income in retirement. That's why it's so important to rebalance. I remember it's happened quite often where you might be investing in your portfolio in your 401k, 60% stocks, 40% bonds, or 60% equities, 40% fixed income, however you want to talk about it. And that's how you're investing it. But because equities over time grow at about twice the rate as bonds or fixed income, 5-10 years from now, your holdings in your 401k might be 80 to 90% equities and 10 to 20% bonds. So you actually think you're investing at 60% equities, 40% bonds, which is pretty conservative, but your holdings are very aggressive. So it's extremely important to, whether you're young, old, in the middle, know how your portfolio is balanced, know how you want it to be balanced, and be rebalancing on a regular basis without timing the market. So step 3, identify holdings to trim. Once you've identified which asset classes you'd like to trim, scout around for specific holdings to cut. This is getting a little too in-depth, but biggest point, try to think about where you're selling. Kind of goes back to the whole rebalancing thing. Step 4, decide how to deploy the assets. Deciding where you'll go for RMDs is the biggest hurdle. Before you take action, however, get a plan for what you'll do with the money. Will you use it for current spending or help it refill your cash bucket to supply next year's living expenses? Or will you reinvest the money into your long-term accounts? Reinvestment can be a good strategy if your RMD amount will take you above your planned withdrawal rate for this year. A taxable account will be your most likely option for RMD subject investors. Alternatively, if you or your spouse has enough earned income to cover the contribution amount, you can steer the cash into an IRA. A Roth will tend to make more sense than traditional for RMD subject investors because RMDs don't apply to Roth assets. Finally, if you're charitably inclined, be sure to consider a qualified charitable distribution. If you're over age 70 and a half, the QCD, Qualified Charitable Distribution, enables you to steer up to $105,000 from your IRA's RMD to the charity of your choice. The beauty of that strategy is that the RMD won't bump up your taxable income at all. Moreover, fewer and fewer taxpayers are apt to be able to get more bang from itemizing deductions, including charitable contributions, than they will from taking the standard deduction. That means that the QCD is a way to be charitable and reduce taxes. Double win. Help society and pay less taxes. Just be sure to decide if you want to do the QCD before pulling the proceeds from the IRA, and check with your IRA custodian to make sure you're following the right steps. You'll likely need your IRA custodian to work directly with your charity to conduct the transfer. Alternatively, if you have check writing privileges with your IRA custodian, you may be able to write the check. So, 3 articles, 3 sort of different points of information, all retirement related. I'll again include this article in the comments. Thank you for those who stopped by this morning. Please, if you have questions or thoughts right now, please leave them in the comments and I'd be happy to address them. Otherwise, if you don't have them right now, please reach out directly or ask comments later, and I'll do my best to answer them. And if you're willing, if you think this conversation was valuable, whether you watched it live or you watched the recording later, please do me a favor and help me help more people by sharing it with a friend, sharing it on your social media page, or sending it directly to someone you know who takes retirement planning seriously. All right, so with that, thank you all so much for your time. I'm not seeing any new questions, thoughts, or comments in the comment section, so I'm going to let you all enjoy your day. Again, it's November 21st. I hope you have a wonderful day, and I look forward to talking to you again, hopefully next week. Bye.